In this lesson, we're going to talk about taxes and their impact on the economy. There's plenty of different types of taxes in any modern economy, including the United States economy. There's the personal income tax, which applies to all types of income, wage and salary, interest, dividends. And that's a tax that applies to an individual, sometimes called the individual personal income tax. And we have the payroll tax, which is just on wages and salaries. It amounts to 15.3% of the total, and that goes to Social Security. Social Security is the sum of what's the employee and the employer pay. They each pay 6.2%, or a total of 12.4%, up to an amount of $113,700. After that amount, you don't pay any more taxes, so it's limited to that amount. And then there's also the tax to support Medicare, and that's also paid by the employee and the employer, up to 1.45%. So when you add all these up, you get 15.3, and that's frequently called the payroll tax. There will be additional payroll tax added to pay for the new healthcare law, so we'll add to that, but that's still part of the payroll tax. Then we have the income tax, which is a tax on corporations' profits. It's 35% in the United States. It's pretty high compared to many other countries. There's arguments it should be lower to improve the competitiveness of American firms. Then there's an excise tax on gasoline. When you go to the pump, you pay some tax. You buy some liquor or beer, you pay taxes. And of course, most states have a significant sales tax, which is applied to whatever it is, furniture, groceries, that you buy in the stores. The estate tax is what you pay when you die on the estate, the tax to the government, and if you give money to people, family members, for example, there's a gift tax if it's over a certain amount. Tariffs are another kind of tax, but they're just on imports into the country. Special name for a tax is tariffs. And then finally, there's property taxes. People have to pay taxes on their property, on their place where they live, on their home, if they own the house and the property. So there's a wide variety of taxes. Note that the payroll tax goes to particular things, like it's payments for Social Security for people who are retired or disabled, and Medicare goes to the health care program for the elderly, as we'll discuss later. It's important to try to get a sense of the magnitudes of these various taxes. So let's look at the federal taxes. Taxes collected by the federal government of the United States as a share of all the revenue, so it gives you a magnitude to think about how large, relatively speaking, is the different taxes are. In this case, the personal income tax is shown to be the highest, a little over 40% of the total revenue raised, but perhaps surprisingly, payroll tax is pretty close, and payroll tax is rising as a share of total taxes paid by individuals. Corporate income tax is pretty small, relatively speaking. That's just on the profits, and even though it's 35%, there's a lot of deductions that firms can take. Excise taxes are a very small part of the federal taxation. Tariffs even smaller, and estate and gift taxes when people die or give money to their heirs, it's even smaller. What's also not clear in this picture, but very important to realize, is that states and local governments also collect taxes, not just the federal tax system. Most of their taxes is in the form of either personal income taxes or excise taxes. They have a much larger fraction of taxes collected on either gasoline or buying food in the store over a certain amount, and that's different by state, so it's a higher level. So federal taxes look like this, state and local taxes are a little different. Now, to think about the effect of a tax, which is really what we're after here in economics, we want to see what's the impact of that taxation on the economy. The taxes are collected, of course, to pay for government and to pay for transfers in the economy, which we'll talk about soon. But the question is, what is the impact of the tax that you have to collect or want to collect? We've discussed this to some extent already in the elementary supply and demand model. We know that a price will rise, interestingly, by less than the tax. We know that the quantity being produced and sold and consumed goes down with a tax. Tax something, you get less of it. We know there's a deadweight loss caused by a tax. That's the degree to which the economy is producing less than the efficient amount. The size of that deadweight loss depends on how much the quantity declines. There's another thing, though, we want to investigate now besides the deadweight loss and these other factors, and that's what's called the incidence of a tax. In incidence, it really who pays the burden of the tax. Is it consumers or firms? If it's a tax on gasoline, do the oil companies and gasoline producers pay the tax, or do the consumers pay the tax? Who pays more, effectively speaking? And that's going to depend on how much the price rises. So if you look back at this slide here, the print in red indicates that the incidence is pretty much going to depend, not pretty much, it is going to depend on how much the price rises, whereas the deadweight loss is going to depend on how much the quantity changes as a result of the tax. So let's now get our supply and demand curves out and think about how all this works. So to illustrate the incidence of a tax and the deadweight loss of a tax, we want to use our supply and demand diagrams with quantity on the horizontal axis and then the price on the vertical axis. In this case, we have a downward sloping demand curve, and we have an upward sloping supply curve. There's two upward sloping supply curves. One represents what supply would be without the tax, and the other with the tax. As we've noted before, when we shift up the supply curve, that represents a higher tax because it's effectively an increase in the marginal cost for the firm. The firm has to send the tax into the government, and so for each unit it sells, it sends in that amount and it raises its marginal cost, as it's shown in the diagram. The supply curve and demand curve are shown here to represent a particular case where there's a low elasticity of demand. You could draw a diagram with a high elasticity of demand and note how that is relatively flat compared to the other. So high elasticity demand represents a situation where the quantity demanded is quite sensitive to the price. Jewelry seems to be quite sensitive to the price. If the price of jewelry goes up, people demand quite a bit less. The steeper or less elastic demand curve represents things that are less sensitive to the price. So that could be the price of cigarettes for elderly people that have been smoking a long time. Now we also want to show what happens with different types of supply curves. So that's illustrated by this diagram, which has two different supply curves with and without the tax, but in this case they're much steeper. That's a low elasticity of supply. Same demand curve as before. But then we also consider a case where there's a high elasticity of supply. Same demand curve as before. So we really have four cases to consider to evaluate the deadweight loss and the incidence of the tax. Again, the deadweight loss is due to the change in quantity on the horizontal axis, and the incidence of the tax has to do with how much the price changes on the vertical axis. So starting with the low elasticity of demand, you can see that there's going to be a reduction in the quantity, but compared to a high elasticity of demand, it's relatively small. The deadweight loss is caused by that reduction in the quantity, so it's that area right there, the area below the demand curve, and above the supply curve without the tax. The supply curve without the tax is what's relevant here because that's the true marginal cost of production for the firm. Now consider the case where there's a high elasticity of demand, and you can see that there's going to be a much greater deadweight loss. In this case, the supply curve shifts, but your movement along the demand curve is larger in the horizontal direction. So now there's going to be a larger deadweight loss compared to the case before where the demand curve was steep or a low elasticity of demand. Now for those two cases, let's also consider the incidence. That's the incidence represented over on the left vertical axis. So in this case, where the demand curve is relatively steep, representing a low elasticity of demand, you can see there's a large change in price. And what that means with the large change in price, that the firm is able to pass on to the consumers a large amount of the tax that it has to pay, the tax being that vertical distance, same as over here, tax being that vertical distance, and a large part of that tax increase, the vertical distance, is paid for by the consumer. In contrast, if you look at the high elasticity of demand case, this is where consumers are more sensitive to the price. Here, there's a relatively small change in price, in this case, small change in price right there. compared to the increase in the tax. So in this case, the firm really can't pass on much of that tax increase. This arrow is much smaller than that arrow, and the incidence of the tax goes onto the firm. So it depends on how high or low the elasticity of demand is. Now let's consider the cases where there's different supply elasticities. So this is the case with a low elasticity of supply. This would be something like land, where you can't change the supply very much, even if there's a tax on it. The supply curve shifts up by the same amount in this case. That's the shift up, same amount as before. But since the supply curve itself is quite steep, you get much smaller change in the quantity. The quantity changes a little bit, and as a result of that, the deadweight loss is quite small. You can't really change the amount of land very much. In this case, it's relatively inelastic, as a low elasticity of supply. And by the same token, you can see the incidence of the tax over on the left vertical axis. Now there's a relatively small change in price because with this low elasticity of supply, only a small change in price is required to get the change in the quantity that's actually supplied. And then finally, by way of comparison, if you go to the case where there's a high elasticity of supply, you see that in this case a large change in the quantity and therefore a large deadweight loss. And over on the vertical axis, you can see in this case there's a large change in price. This is a case where the high elasticity of supply, so the price changes a lot, and the firms in this case are able to pass on a larger fraction of the tax increase to consumers. And that's shown in this picture here. That arrow is almost as large as the arrow representing the size of the tax increase. So it really matters for both incidence of the tax, who effectively pays it, and for the deadweight loss, the loss to society in terms of efficiency. It matters which curve has a high elasticity, which curve has a low elasticity, and these diagrams illustrate that. I think it's important when you think about diagrams to think about particular examples. I mentioned land as a case where there's a low elasticity of supply. You could think of just pumpkin production or any kind of agricultural production where there's a relatively high elasticity. This is the case. The low elasticity is where there's land, high elasticity of these other products. And the same with respect to demand. You can think of there being a low elasticity of demand for things like cigarettes and a high elasticity of demand for jewelry. Now let's consider the tax, income tax on items, in particular a tax on labor. Remember, income tax applies to both labor, income from labor meaning wages and salaries, but it also applies to investment income such as dividends and interest. For most people, the largest part of their income is wages and salaries, so for them an income tax is effectively a tax on labor. And so you can analyze the income tax in the same way that we've analyzed the other kinds of taxes, except you have to use a labor supply and labor demand diagram as illustrated in this picture. On the horizontal axis, we have hours of work. On the vertical axis, we have the wage. We have a labor demand curve. It's downward sloping, representing the marginal revenue product to the firm, and the upward sloping supply curve representing the labor-leisure trade-off for the workers. The case of an income tax means that the worker is going to have to pay tax to the government, and so we want to shift up the labor supply curve, which represents the decisions of the worker, by the amount of the tax. And so you can see that in this picture, we're shifting up the labor supply curve by the amount of the tax. And you can think of that shift up as due to the fact that the worker has to pay taxes to the government. So just for example, suppose you're here without the tax, that's called old labor supply, and that represents the amount that the worker would supply in terms of labor, hours of work per week or day or whatever it happens to be, and that would be the wage that the worker would be willing to supply at that wage. Suppose that's $10 an hour. And suppose the tax increase is $3 an hour. And so that's $3 right there. Then the worker would be indifferent to having $10 with no tax or $13 with a $3 tax, still gets $10. So that means that this has to ship up by $3, so effectively this becomes $13. And if it's $13 and he has to pay $3 in tax, you'll still work the same amount as if it's a $10 wage and no tax. So you represent in that diagram by simply shifting up the labor supply curve by that amount. Now we get a prediction. We move from the initial equilibrium there to the new equilibrium there with the higher tax. We right away predict that there'll be a decline in the amount of employment. The firms, as they see the change in circumstances, as they see this shift in the supply curve, they're going to actually reduce the amount of quantity, reduce the quantity of labor demanded, and the wage will go up. Remember, that shift upward in the labor supply curve is causing this, and the increase in the wage is shown over here by that distance between those two. And if you look carefully, the size of that shift up is quite a bit less than the size of that shift there. So while the wage goes up, according to the model, it doesn't go up by as much as the tax. So effectively, the worker is taking home less money, even though the wage is higher, because the tax is even higher than the higher wage. So the overall impact of the tax on labor is to reduce the quantity of labor and reduce, of course, the after-tax wage that the worker gets. Now consider what happens when the tax is paid by the firm. That's illustrated over in the left. We have the supply and demand diagrams again in the same diagram, but here we're going to shift the demand curve. We're going to shift it down from the old demand curve to the new demand curve as labeled in the diagram. Why does it shift down? Well, remember, the demand curve represents the marginal revenue product to the worker and from the worker. And so if the firm has to pay additional tax, its revenue is going to go down by that tax. It's going to get less as a result of this production. And so effectively, it's a shift down in the labor demand curve by the amount of the tax, and that's what's illustrated right here. So now you have a prediction, as always. We have the original equilibrium up here at the old demand curve and the supply curve. We got a new equilibrium down here at the new demand curve with the tax, and our prediction is that the quantity of labor goes down and that the wage goes down. Now in this case, the wage is going down, and so the worker is getting paid less. The worker is not paying any tax in this case. The worker is just getting a lower wage. The firm is paying the tax. The amount of labor actually transacted, exchanged, the hours of work, it goes down in this diagram just as it did in that diagram. So the impact is the same on the amount of employment in the economy, whether it's the employee or the employer pays the tax. And on the vertical axis, that decline in the wage, as you can see there, is less than the size of the tax. So effectively, the worker shares some of the cost of the higher tax with a lower wage. It doesn't completely match the reduction, the amount of the tax increase, so the worker shares in this with the firm. The firm also has to pay some of the tax. It's exactly the same as over on the right, where both the worker and the firm share in the effective burden of the tax, regardless of who literally is asked to pay by the government. So given all this, now let's consider some other issues related to taxation. One is, what's the effect of this tax rate on tax revenues? Remember, one of the reasons to have a tax system is to raise revenues to pay for the government. So you want to think what happens if you raise taxes, how much do you raise revenue? Well, you'd think they're probably going to raise more revenue as you have a higher tax rate. But that's not always the case. And this little table here, very simple table, tries to illustrate that. So we have different examples of a tax rate. That's labeled in red, 40% tax, 60% tax, 80% tax. And the represented 0.4, 0.6, 0.8, and on the next column, labeled in green, is an assumption that it's $20 an hour for this particular type of work. And then we have hours of work on the far right. And as you can see, as the tax rate rises, the hours of work go down. That's just what our diagrams have shown. The higher tax rate reduces the hours of work, the quantity of labor supplied. To get the tax revenue, we multiply the tax rate times the total amount of labor income. The total amount of labor income is the wage the worker gets per unit of work, say per hour, times the number of hours, L. So the total revenue is little t times little w times L. So in this table, I've just multiplied those three together. So 8,000, for example, is 0.4 times 20,000. The tax rate goes up to 0.6, and the revenue goes up because the tax rate has gone up. But note that hours worked has gone down from 1,000 to 700. And then finally, we see the 80% tax rate. That's a pretty high tax rate, of course, and labor supply goes down even to 400 hours in this case. In this case, when you multiply it through together, you see that actually tax revenues go down, now from 8,400 to 6,400. So it's possible to get tax rates to be so high that you actually reduce the amount of revenue coming into the government. And this little table can be represented in a curve, which is actually a very famous curve, sometimes called the Laffer curve, after economist Art Laffer, who talked about this in public policy, trying to recommend tax changes in the 1980s. And it represents just what I showed you in this other picture. You got tax rate on the vertical axis and tax revenue on the horizontal axis. If you have a zero tax rate, you collect no tax revenue. And then as you start to increase the tax rate goes up, the amount of revenue rises. You saw that in the example. But then at some point, the tax rate gets so high that workers' labor supply starts to decline so much that you actually have a reversal, higher tax rates. In this case, higher tax rates generating lower amount of tax revenue. At the extreme in the diagram, 100%, it's logical to think that if everything you earn is taken away by the government, that there's not much incentive to work at all, and so you could guess that tax revenue is effectively zero. So you know that that's on the diagram. You know that's on the diagram, and so somehow they got to go like this. But whether it's this way or that way, you don't really know. That depends on the empirical evidence and how responsive people are. But we do know that this Laffer curve has this tendency to reverse itself at very high tax rates. Let's consider some income tax terminology to finish this off. It's important to think about when you're discussing tax reform or tax ideas. One is this idea of the marginal tax rate. That's the tax paid on an additional dollar of income earned. If you earn another dollar and you pay 30% tax on that dollar, that's a 30% marginal tax rate. If your tax rate is 70%, you earn a dollar, you pay 70 cents in taxes, that's the marginal tax rate of 70%. The average tax rate is different. That's the total taxes you pay as a percent of your total income. The average tax rate is going to be lower than the marginal tax rate for high income individuals because they're paying a larger amount of their taxes on each extra dollar in a progressive tax system. Progressive tax system means a situation where people pay a larger fraction of their taxes if they're wealthy than if they're relatively poor or have lower incomes. Regressive is that they pay a lower fraction of their taxes at high income than at low income. It's also important when you think about taxation to think of something called taxable income. Most tax systems get a chance for people to reduce some of their taxable income by something called exemptions. Exemptions are a certain amount you get to deduct per person. So in the U.S., it's $3,900 at this point. There's also you can deduct from your income and therefore pay less taxes on your taxes because your taxable income will be lower. In the U.S., a married couple gets to deduct $12,200. So what that would mean is a family of four to a couple with a couple kids would get to have exemptions of 4 times $3,900, another standard deduction of $12,200, and effectively be able to earn $27,800 before they pay any tax at all, because they would have an income of $27,800, be able to deduct that, and effectively have zero taxable income. So you always think about taxable income when computing taxes and when thinking about marginal tax rates. So finally, let's just consider some examples. I just got a couple of tables here you can study at your leisure. These are tables from the tax forms that the government sends around for the personal income tax. And as you look at the area where I've circled, these are the tax rates on different amounts of income. So the lowest tax rate is 10% for incomes that's at the very top of each of these pictures. The picture at the top is for a single person. The picture or the table at the bottom is for a married couple. And you can see at very low incomes, their marginal tax rate is 10%. They pay a dime for each extra dollar they earn up to that amount. But at the other end of the table, you see the tax rate is much higher, and that represents the fact that the tax system is progressive. As you had higher incomes, you pay a higher rate on each extra dollar you earn. The table here is shown for 2012. It's interesting that in the end of 2012, early 2013, the tax rates were changed, and particularly the marginal tax rates were raised for people near the top. And so these tables are still being completed by the government since it's a recent tax change, but you can see if you look carefully and then study these at your leisure that the top marginal tax rate is now 39.6% for singles and for individuals. And then what was 33% becomes 35%. Everything else is the same. So for the most part, the taxes in 2012 are the same as 2013, except for those at the very top. Now finally, let's consider what you might do to make the tax system better based on what we've done so far in this analysis from an economic perspective. Well, first of all, we've seen that these tax rates, they do cause changes in behavior. They have a reduction in the amount of hours worked, labor supply at the higher tax rates. There's a change in the amount that's produced by goods because of higher tax rates. There's a deadweight loss caused by that. So in some sense, it would be better to have lower marginal tax rates. And if you wanted to raise the same revenue, then you could just expand the amount that's being taxed. So the idea is you lower the tax rate. That reduces the deadweight loss and the inefficiencies, as we have illustrated here. But to raise the same amount of revenue, then you want to tax more. You want to maybe reduce the amount of deductions or reduce the amount of exemptions or whatever you want to do to really make the tax base, the amount which is taxed, larger. Eliminating those things, those deductions, those exemptions is sometimes called the elimination of tax expenditures, or just simply the elimination of loopholes. So the idea behind tax reform is to make the tax system less of a burden, if you like, less deadweight loss, and to raise the same revenue, you do that by lowering marginal tax rates and expanding the base at the same time. And that's what tax reform is. We've had tax reforms in the United States in the 60s and in the 80s, and many people hope we'll get tax reform again in the future. Thank you.